I don't need a crystal ball for my investing strategy. There's no fortune tellers, there's no mystery. It's just simply the right plan, and I use the right amount of time. So for this video, I'm going to give you a few options, and I'm going to break down my distribution to see as maybe a benchmark for you. In 1786, 14-year-old Marie Drummond ran away from the convent school where she was raised. Drummond set off to Paris on her own, where she learned the art of cartomancy, divination using a deck of cards. She worked for 40 years as a cartomancer and fortune teller, advising Napoleon's wife, Robespierre, and important figures on their fates. Now, you don't need a fortune teller, all right? The monthly savings needed to have $1 million invested by the time you get to 67 with a 6% return is listed here. You got at age 25, if you invest $438 each month, then you're going to end up with $1 million when you retire at 67. That goes up quite a bit when you get to ages 30, and by age 40, it's $1,200. As promised, let's get into it. Here's 3 different distributions that I've used for my own investments or will be using in my future. That's the third one here. So to start out with, the first way that started out investing was basically just in stocks. I grew up in a conservative mindset, so I'm not talking about individual stocks. There were no meme stocks when I started investing. When I say stocks, I mean index funds, mutual funds, ETFs, diversification. That's a key thing that I harp on all the time. As soon as we bought our first house, that's where half of this went into. It was more of a 50-50 blend between stocks and real estate. As far as I'm concerned, that's a healthy balance. So I know this looks rough, but you get the gist. In your 20s, 50% stocks, 50% real estate. Now, not my 20s anymore. I have kids. I've got a wife. I've got a career, got a business. I'm trying to build all this stuff, and I want a little bit more stability. And frankly, on the buy side of my total investment approach, I've been buying into more bonds. And so when I used to think bonds were for people that were basically in the third chapter of their life, retirement and beyond. With your 20s and getting into my 30s, I have a distribution. I really haven't changed my real estate and stock holdings that much. I kept a good 50-50 balance. But as I buy more bonds in recent times, especially with rates and everything, bonds have become a larger portion than they ever were before. If you're someone who today is, let's say, in your 50s, your 60s, your 70s, then you're going to likely want a more conservative distribution between your stocks, real estates, and bonds. And to be fair, you're probably looking for more passive ways of investing. You're going to have, as far as real estate goes, a rental house that you're having to go and manage on a more hands-on basis. If you find yourself later in life, you can start to see where things are trending towards. This would be a more stable place to invest in your retirement versus something like the equities market. And then finally, the distribution that I'm headed towards is something trending more towards this side. And so my 40s, which are coming up sooner than I like to admit, extra 10% over here is what I would call alternative asset classes. When I say alternative asset classes, I don't mean Pokemon cards. I don't mean Rolex watches. Those are fine, and that's a true alternative asset class. But there are other ways that you can still have diversification. I would be stressed if I had anything that had that significant of value in the 6 figures value just sitting around in my house or in a safe or something. I would want it somewhere else. So there are now ways and many means that you can invest in fine art, but in a way that you're investing into a fund that then goes and buys, holds, manages, and sells that fine art. You're not going to see me going and buying a Picasso, throwing it in the back of my minivan, hanging it up on a wall somewhere in our house. That is not us whatsoever. But for us, these alternative asset classes, these are essentially just a hedge against some of the chaotic times. And so as different markets go up and down in a cycle, right now we're seeing stocks not in a great place. They went way up after the pandemic, and now we're seeing a decline. It's not a huge drop, but we're back to where we were before a big part of this jump. Now, real estate is kind of going the same way. Maybe we're in this zone. It hasn't dropped as much, but we're also in a downwards trend. Meanwhile, bonds were down here and they're headed up. So you can kind of see how this balances out. Some of that big appreciation has happened in some commodities that are more alternative. And so I'm not talking about crypto, even though that is one example of an alternative asset class. We can have like 1%, 2%, 3% of our net worth in this portfolio invested in crypto. But the expectation is that you would find some of these things and preferably something that you actually know about. And so for me, I know about music. That's my background and my education was in music. I know about insurance. That's my day job. So maybe there's some ways that I can invest in some of those things. And a big part of this alternative asset class here is businesses, because one, I love business. I love management. I love sales, and I can provide some value there. And on top of that, it's a great ROI if you can build and or invest in a business that's going to give you returns. And so as you see trending away from just pure stocks and real estate, I've hedged with some bonds in my 30s, and rates led a lot of people in that direction. And I'm going to continue to probably head that direction in a more conservative way. But all of these are going to continue to get invested in over the course of time. But the next 10 years, I'm not going to stop investing in stocks altogether. I'm going to invest in each of these and continue to have them trend towards this overall distribution goal. So to sum things up, here's the 3 recommendations that I follow for our own investments and our long-term plan. Number 1, it's just got to open an account. So if you don't have a place to put the money, if you're storing a bunch of cash under the mattress or just in a checking account somewhere, then it's not going to be compounding and it's not going to be working for you. So you need to open up an account somewhere, and there's a lot of great options out there. I would go somewhere where there's virtually just no fees, because you don't want to have anything that's holding you back when there's so many free options out there. The second thing is, when you're really looking at the different examples we ran through in your distribution of what you're investing in and how much, then it's probably a good idea to consult an advisor. And I know a lot of people out there, they are pro-advisor or anti-financial planner and all this stuff, but at a certain point, you look at all the wealthiest people out there and they delegate. They delegate their money to someone else who's got the experience, the wisdom, and they do that full time, paying attention to growing your account. And there's key terms like having someone who's a fiduciary and someone who has those ethical standards and practices that they follow. I've got an advisor that I use. I'm pretty biased. I think he's pretty great. And that's where you want to potentially be starting. But if you don't start out there, my recommendation is somewhere along your journey, through the different examples, that you'll transition to using someone to work and fight for you, your corner. And then finally, to start simple. So, 99% of the time when people come to me and they say, what should I be investing in? Now, this isn't advice. This isn't me telling you what you should do. This is just what I'm describing in my practice, is to start simple. Look at those whole market index funds as a good starting point to really understand the process. And you have plenty of time. No matter if you're in your 30s, 40s, 50s, 60s, you've got time